The crocodile does not chase every fish that swims by. It waits, it calculates, it conserves energy until the perfect moment to strike. In investing, this is not a metaphor, it is a methodology. Most retail investors operate like frantic birds, pecking at every market movement, reacting to headlines, buying on hype, selling in panic. The crocodile investor does none of that. He understands that volatility is noise, not signal. He knows that time in the market beats timing the market, not because it is a cliché, but because decades of data prove it. His edge is not intelligence or access to insider information. It is discipline, discipline to do nothing when nothing should be done, discipline to hold when others panic, discipline to buy when blood is in the streets, not because he enjoys chaos, but because he has trained himself to see opportunity where others see disaster. The crocodile does not need to be the fastest or the smartest predator. It needs to be the most patient. In the stock market, speed is often a liability. High-frequency traders, day traders, meme stock chasers, they are the cheetahs of the financial jungle, explosive, impressive for a moment, but unsustainable over time. The crocodile investor builds positions slowly, methodically, based on fundamentals, not momentum. He ignores quarterly earnings hysteria and focuses on decade-long trajectories. He does not care if a stock drops 20% in a week. He cares if the business model is still intact, if cash flow is growing, if management is aligned with shareholders. He measures success not in daily P&L, but in compound annual growth over 10, 20, 30 years. This mindset requires rewiring your brain. Humans are wired for action, especially in environments of perceived danger or opportunity. The stock market triggers both constantly: red numbers, danger; green numbers, opportunity. The crocodile investor overrides this instinct. He creates systems, not emotions, to govern his decisions. He sets buy zones based on valuation models, not FOMO. He sets sell criteria based on business deterioration, not price targets. He does not feel his way through markets. He calculates, he backtests, he plans. His portfolio is not a casino. It is a collection of ownership stakes in real businesses, selected with the same seriousness as buying a house or starting a company. One of the biggest mistakes investors make is confusing activity with progress. Checking your portfolio 10 times a day, switching stocks every month, reacting to every CNBC headline. That is not investing, that is gambling with extra steps. The crocodile does not move unless movement serves a strategic purpose. If a stock is undervalued and the thesis is intact, he holds, even if it takes 3 years to appreciate. If a business is broken beyond repair, he exits, even if the stock is up 50%. His decisions are binary: thesis valid equals hold or add, thesis broken equals sell. No gray areas, no emotional attachments, no "but I bought it at" excuses. He treats every position as if he were buying it today, regardless of what he paid yesterday. Valuation is the crocodile's compass. He does not buy good companies. He buys good companies at good prices. A wonderful business trading at 50 times earnings is not an investment. It is a speculation. The crocodile investor uses metrics like free cash flow yield, EV to EBITDA, P to E relative to growth, and owner earnings to determine intrinsic value. He does not rely on Wall Street price targets or analyst upgrades. He builds his own models, conservative by design, and only pulls the trigger when the margin of safety is wide enough to absorb error. He knows that even the best businesses can be bad investments if you overpay, and mediocre businesses can be great investments if you buy them cheaply enough. The crocodile does not need to be right all the time. He just needs to be right more often than wrong. And when he is right, he lets winners run. He understands that in investing, asymmetry is everything. A 10-bagger does not come from a stock that goes up 10%. It comes from holding a position for years as fundamentals compound. He does not sell a stock because it doubled. He sells it when the business stops growing or becomes overvalued. He does not average down out of ego. He averages down only when the original thesis is stronger than ever and the price is even more attractive. His portfolio is concentrated, not because he is reckless, but because he knows diversification beyond 10 to 15 high-conviction names dilutes returns without meaningfully reducing risk. Risk, to the crocodile investor, is not volatility, it is permanent loss of capital. He does not fear drawdowns, he fears bad decisions. He does not hedge with options or try to time recessions. He hedges by owning resilient businesses with strong balance sheets, pricing power, and low debt. He avoids leverage like poison because leverage turns temporary losses into permanent ones. He does not invest in businesses he does not understand. No crypto, no biotech moonshots, no pre-revenue startups. He sticks to what he knows: cash-generating enterprises with durable competitive advantages, run by honest management, trading below intrinsic value. The crocodile investor is a student of human behavior because markets are driven by humans, and humans are predictably irrational. He does not fight the crowd. He waits for the crowd to exhaust itself. When everyone is euphoric, he becomes cautious. When everyone is terrified, he becomes aggressive. He reads financial history not for entertainment, but for pattern recognition. Tulipmania.com bubble, housing crash, meme stock frenzy, the names change, the psychology does not. He knows that bear markets are not anomalies. They are features of the system, and he prepares for them by holding cash, not out of fear, but out of anticipation. He does not need constant validation. He does not post his portfolio online. He does not argue with strangers on Reddit about stock picks. He does not measure his self-worth by his net worth. He invests in silence, tracks progress in spreadsheets, reviews performance annually, not daily. His goal is not to beat the market this quarter. It is to preserve and grow capital over decades, so he can live life on his own terms. He does not chase alpha. He chases peace of mind. He knows that the richest investors are not the ones with the highest returns. They are the ones who slept well during every crash. This is not a strategy for the impatient. It is not sexy. It will not make you famous on Twitter, but it will make you rich, quietly, steadily, inevitably. The crocodile does not care about applause. He cares about survival and then domination. In investing, survival means not blowing up your portfolio. Domination means compounding wealth at 10 to 15% annually for 30 years. That is how you turn $10,000 into $175,000. Then into $3 million, not by being brilliant, by being boring, by being still, by being the crocodile. Not every company deserves your capital, only those with structural advantages that endure through economic cycles. The crocodile investor does not chase trends. He identifies timeless engines of cash generation. These are businesses with wide moats, brand loyalty, network effects, cost advantages, regulatory protection, or high switching costs. Think Coca-Cola, not a viral TikTok brand. Think Visa, not a crypto exchange. Think Costco, not a flash sale e-commerce startup. Durability is the first filter. If a business cannot survive a recession, it does not belong in a crocodile's portfolio. The second filter is management. The crocodile does not trust charismatic CEOs with vague visions. He trusts operators with skin in the game. He looks for executives who own significant shares, who speak plainly in earnings calls, who prioritize long-term shareholder value over short-term optics. He avoids companies where management constantly changes strategy, overpays for acquisitions, or uses aggressive accounting. He prefers boring, frugal, operationally excellent leaders, the kind who reinvest profits wisely, not the kind who buy private jets and throw investor galas. Management is not a footnote, it is the foundation. Cash flow is the lifeblood. The crocodile investor ignores EBITDA. He focuses on free cash flow. EBITDA can be manipulated, cash cannot. He wants to see consistent, growing, predictable cash generation, not just revenue growth. Many companies grow revenue by burning cash. That is not a business, that is a charity. The crocodile looks for businesses that convert at least 70% of net income into free cash flow. He avoids capital-intensive industries where cash is constantly eaten by maintenance CapEx unless the returns on that CapEx are exceptional. He wants cash he can touch, reinvest, or return to shareholders, not accounting profits on paper. Margins matter, but not in isolation. High margins are useless if they are unstable. The crocodile looks for businesses with stable or expanding margins over 10+ years. Not just one good quarter. He studies gross margins, operating margins, and net margins not to compare them to peers, but to track their trajectory over time. Declining margins are an early warning sign. Even if revenue is growing, he asks, is the company losing pricing power? Are costs rising faster than sales? Is competition eroding profitability? If yes, he walks away no matter how cheap the stock looks. Balance sheet strength is non-negotiable. The crocodile does not invest in companies with excessive debt, especially floating rate debt in a rising interest rate environment. He looks for net cash positions, or at least debt to EBITDA ratios below 3 times. He avoids companies that rely on constant refinancing to survive. He wants businesses that can weather a 2-year recession without needing to raise capital or sell assets. Strong balance sheets allow companies to buy back shares, acquire competitors, or invest in growth during downturns. While weaker competitors bleed out, that is when crocodiles feast. Capital allocation is where great companies become great investments. The crocodile does not care if a CEO is a visionary. He cares if the CEO is a good capital allocator. How does the company deploy its cash? Does it reinvest at high rates of return? Does it buy back shares when they are undervalued? Does it pay sustainable dividends? Or does it waste money on low-return acquisitions, bloated R&D, or empire building? The crocodile studies 10-year capital allocation records, not press releases. He wants evidence, not promises. Competitive positioning must be defensible. The crocodile asks, Can this company raise prices without losing customers? Can it survive if a new competitor enters the market? Does it have proprietary technology, patents, or distribution advantages? He avoids commoditized industries where price is the only differentiator. Unless the company is the absolute lowest cost producer, he prefers businesses where customers are sticky, software with high switching costs, subscription models, regulated, utilities, essential consumer staples. He does not bet on disruption. He bets on resistance to disruption. Scalability is key for long-term compounding. The Crocodile looks for businesses that can grow without proportional increases in cost. Software, payment networks, digital marketplaces, these have near zero marginal costs. A restaurant chain or manufacturing company, much harder to scale efficiently. He does not avoid physical businesses, but he demands exceptional unit economics and regional dominance. He wants businesses that can double revenue without doubling headcount or capex. That is how you get exponential returns on capital. Valuation must align with quality. A wonderful business at a fair price is a good investment, but a wonderful business at a cheap price is a crocodile's dream. He uses multiple valuation methods, DCF, reverse DCF, sum of the parts, precedent transactions. He does not rely on P/E alone, especially for cyclical or high-growth companies. He compares valuation to historical averages, to peers, and to the broader market, but always through the lens of long-term cash flow generation. He buys when the market misprices the future, not when it celebrates the present. Finally, the Crocodile investor demands alignment. He wants to see insiders buying shares, not selling. He wants compensation tied to long-term performance, not short-term stock price. He wants a board that challenges management, not rubber stamps it. He avoids companies with dual-class shares that disenfranchise public investors. He invests only where incentives are aligned, where management success is your success, because in the end, you are not betting on charts or catalysts, you are betting on people, and the Crocodile bets only on people who bet on themselves. Valuation is not an exact science, it is a range. The Crocodile investor does not seek precision, he seeks probability. He knows that intrinsic value is a moving target, influenced by interest rates, inflation, competition, and consumer behavior, so he does not calculate one fair value. He calculates 3, bear case, base case, bull case. He assigns probabilities to each, then weights them. If the current price is below even the bear case, he buys aggressively. If it is above the bull case, he sells. If it is in between, he waits. He does not force trades, he lets valuation come to him. Discounted cash flow is his primary tool, but not the simplistic version taught in business schools. The Crocodile builds conservative models, low revenue growth, high discount rates, terminal values based on GDP growth, not fantasy. He assumes no miracles, just steady, boring execution. He stress tests every assumption. What if growth is 2% lower? What if margins compress by 5%? What if WACC rises by 200 BPS? If the stock still looks cheap under pessimistic scenarios? It is a candidate if it only works in a perfect world. He discards it. Hope is not an investment thesis. He never relies on a single metric. P/E is useless for asset-heavy or cyclical companies. P/B is meaningless for software firms. EV to EBITDA ignores capex. The Crocodile uses a mosaic FCF yield, EV to EBIT, P to FCF, ROIC versus WACC, earnings yield versus bond yields. He compares these metrics to the company's own history, to its industry, and to the market. He looks for anomalies. A company trading at 8 times P/E while growing earnings at 15% per year. In an industry that typically trades at 20 times, that is not cheap. That is mispriced. That is where crocodiles strike. Relative valuation is dangerous if used alone, but powerful when combined with absolute valuation. The Crocodile does not buy a stock just because it is cheaper than peers. He asks, why is it cheaper? Is the market wrong, or is there a hidden flaw? He digs into footnotes, conference call transcripts, customer reviews, supplier relationships. He looks for disconnects between perception and reality. Often, the cheapest stock in a sector is cheap for a reason, but sometimes it is cheap because the market overreacted to temporary bad news. That is his hunting ground. He pays special attention to free cash flow yield, FCF divided by enterprise value. A yield above 8% is attractive. Above 12% is exceptional, assuming the cash flow is sustainable. He compares this yield to the 10-year Treasury yield. If a stock yields 10% in FCF and Treasuries yield 4%, the equity risk premium is 6%. Historically, that is a strong buy signal. He does not expect this premium to compress immediately. He expects it to persist for years, giving him both yield and multiple expansion. That is the double win crocodiles love. The Crocodile avoids growth at any price traps. A company growing revenue at 30% but burning cash is not an investment, it is a speculation. He demands that growth be profitable or at least funded by operations, not debt or equity issuance. He looks for operating leverage. As revenue grows, margins expand. He avoids businesses where growth requires ever-increasing capex or marketing spend. That is a treadmill, not a compounding machine. He wants growth that generates surplus cash, not growth that consumes it. He uses reverse DCF to test market expectations. What growth rate and margin profile is the current stock price implying? If the market is pricing in 15% annual growth for the next decade, but the company has never grown faster than 5%, the stock is expensive. No matter how low the P/E looks, the crocodile does not argue with the market, he lets the math speak. If the implied expectations are unrealistic, he sells. If they are too pessimistic, he buys. He does not care about sentiment, he cares about embedded assumptions. Margin of safety is his armor. He never pays full value. He demands a 30 to 50% discount to his base case intrinsic value. Why? Because he knows he is often wrong, models fail, management stumbles, economies collapse, competitors innovate. The margin of safety absorbs error. It turns near misses into wins. It allows him to sleep through volatility. He does not need to be precisely right. He just needs to be approximately right at a deeply wrong price. That is how crocodiles survive and thrive in uncertain environments. He revisits valuations quarterly, not to trade but to update assumptions. Did the company raise guidance, lower capex, lose a major customer, win a regulatory approval? He adjusts his models accordingly. If the intrinsic value rises and the stock price has not, his position becomes more attractive. If the intrinsic value falls and the stock price has not, he considers trimming. He does not anchor to his original buy price, he anchors to current intrinsic value. His portfolio is dynamic, not static. Finally, the crocodile knows that valuation is useless without patience. A stock can stay cheap or expensive for years. He does not fight that. He uses it. He adds slowly on weakness. He trims on strength. He does not average down blindly. He averages down only when his thesis is stronger and the price is cheaper. He does not chase momentum. He waits for mean reversion. He knows that markets are inefficient in the short term, but brutally efficient in the long term, so he plays the long game. He lets time and compounding do the work. He does not need to be right tomorrow. He needs to be right in 10 years, and he will be. The crocodile does not diversify to reduce risk. He concentrates to maximize return. He knows that owning 50 stocks does not make you safer. It makes you average. It dilutes your best ideas and exposes you to mediocre ones. He typically holds 10 to 15 positions. No more. Each position must meet his strict criteria: durable business, strong management, clean balance sheet, attractive valuation, alignment of incentives. If a stock does not clear all 5 hurdles, it does not get in. No exceptions. His portfolio is small by design because excellence is rare. He sizes positions based on conviction and margin of safety, not arbitrary percentages. His highest conviction idea might be 15 to 20% of the portfolio. Not because he is reckless, but because he has done the work. He knows that in a 10-stock portfolio, the top 3 performers will generate 80% of the returns, so he allocates accordingly. He does not cap positions at 5%. To be safe, he caps them only when the risk-reward deteriorates. He wants his winners to matter, not to be drowned out by noise. Cash is not a drag, it is a weapon. The crocodile keeps 10 to 30% in cash at all times, not out of fear, but out of discipline. He knows that opportunities come in clusters, usually during panics. He does not feel pressure to be fully invested. He would rather hold cash for a year than buy a mediocre stock today. Cash gives him optionality, the ability to pounce when others are forced to sell. He does not view cash as missing out. He views it as dry powder, and in bear markets, dry powder is king. He never uses leverage, ever. Leverage turns volatility into ruin. It forces you to sell at the worst possible time. It turns temporary drawdowns into permanent losses. The crocodile knows that the path to wealth is not steep, it is long and steady. He does not need 3 times ETFs or margin loans to get rich. He compounds at 12% annually for 30 years. That is enough. Leverage is for gamblers. Crocodiles are owners. They do not borrow to buy, they save, they wait, they strike. When the price is right, no debt, no exceptions. He rebalances, but not frequently. He reviews his portfolio quarterly, but only trades when valuations shift materially. If a stock doubles and becomes overvalued, he trims, not to lock in gains, but to maintain risk discipline. If a stock falls 30% but the thesis is stronger, he adds, not to average down, but to increase ownership of a mispriced asset. He does not rebalance to target weights. He rebalances to valuation bands. His portfolio is valuation-driven, not index-hugging. He avoids thematic bets. No AI portfolio. No clean energy basket, no metaverse plays. He invests in individual businesses, not trends. Trends fade, businesses endure. He does not care if a company is in a hot sector. He cares if it has pricing power, cash flow, and a moat. He would rather own a boring utility with a 5% FCF yield than a hyped AI startup burning cash. He knows that sectors go in and out of favor, but quality compounds regardless. He does not chase performance. He chases durability. He does not hedge, he does not buy puts, he does not short stocks to balance his portfolio. He knows that hedging costs money, and usually fails when you need it most. Instead, he hedges by owning resilient businesses, consumer staples, healthcare, utilities, payment networks. These hold up in recessions, not because they are defensive, but because they provide essential services with inelastic demand. He does not need complex derivatives. He needs simple, strong businesses. He measures performance annually, not daily, not monthly. He compares his returns to a benchmark, but only over 5+ year periods. Short-term underperformance does not bother him as long as his process is intact. He knows that even the best strategies underperform for 2 to 3 years at a time. He does not chase benchmark returns, he chases absolute returns. His goal is to compound at 10 to 15% per year. Regardless of what the S&P 500 does, he is not competing with the market, he is building wealth. He avoids recency bias. Just because a stock has gone up does not mean it is good. Just because it has gone down does not mean it is bad. He evaluates each position based on current fundamentals, not past price action. He does not sell winners too early out of fear. He does not hold losers too long out of hope. He resets his mental cost basis to zero every quarter. He asks, if I did not own this today, would I buy it at this price? If yes, hold. If no, sell. Simple, brutal, effective. Finally, the crocodile knows that portfolio construction is psychological as much as financial. He structures his portfolio to survive his own emotions. He does not hold volatile small caps if they will make him panic sell. He does not chase yield if it will make him reach for risk. He builds a portfolio that lets him sleep so he can stick with it for decades, because the best strategy in the world is useless if you abandon it in year 2. The crocodile does not optimize for Sharpe ratio. He optimizes for adherence. He builds portfolios that last, not just perform. The crocodile does not have buy signals. He has buy zones. He identifies a range of prices where a stock is undervalued, and he accumulates slowly within that range. He does not try to catch the bottom. He knows it is impossible. He buys in tranches, 25% at the top of the buy zone, 25% at the midpoint, 25% at the bottom, 25% if it breaks below due to panic. He uses limit orders, never market orders. He does not chase, he waits. He knows that in illiquid or volatile markets, patience is rewarded, rushing is punished. He never buys based on news, tips, or momentum. He buys only when 4 conditions are met. The business is durable, management is aligned, the balance sheet is strong, and the price is below intrinsic value with margin of safety. If anyone is missing, he walks away no matter how tempting the story. He does not make exceptions for great companies or once-in-a-lifetime opportunities. He has a checklist, and he follows it religiously. Discipline is his edge. His sell discipline is even stricter. He sells for only 3 reasons. The thesis is broken, the business deteriorated, management turned dishonest, moat eroded, the stock became significantly overvalued, not expensive, but priced for perfection with no margin of safety, or he found a better opportunity, higher quality, cheaper price, stronger risk-reward. He never sells because of market crashes, macro fears, or short-term volatility. He never sells to lock in profits. He sells only when the math or the facts change. He does not average down emotionally, he averages down analytically. Before adding to a losing position, he reruns his valuation model. Did the intrinsic value rise or fall? Is the margin of safety wider or narrower? If the business got stronger and the price got cheaper, he adds. If the business got weaker, even if the price is lower, he does not double down on conviction. He doubles down on improved fundamentals. He separates ego from analysis. He is not married to his positions, he is married to his process. He does not set price targets. Price targets encourage selling too early. Instead, he sets valuation thresholds. He sells when EV to EBITDA exceeds 15 times, or FCF yield falls below 4%, or ROIC drops below WACC for 2 consecutive years. These are objective, measurable, tied to fundamentals, not arbitrary price levels. He does not care if a stock hits $100. He cares if it is still cheap at $100. If it is, he holds. If it is not, he sells. No sentiment, no anchoring. He ignores technical analysis. He does not care about moving averages, RSI, MACD, or chart patterns. He knows that price is a lagging indicator, fundamentals are leading. He does not trade breakouts or support levels. He trades valuation gaps. He does not watch stock charts. He reads 10Ks, earnings transcripts, and industry reports. He is not a technician. He is a business analyst. His edge comes from understanding value, not price momentum. He does not time the market, but he times his entries. He does not try to predict recessions or rate cuts, but he waits for panic to create mispricing. He knows that the best buying opportunities come when others are forced to sell. Margin calls, fund redemptions, earnings misses, sector rotations. He does not fear volatility. He exploits it. He keeps a watch list of high-quality businesses, and he waits for them to go on sale. He does not force buys. He lets the market bring him deals. He does not sell winners to take profits. He lets winners run, as long as the thesis is intact and valuation is reasonable. He knows that his 10 baggers will come from his winners, not his average performers. He does not cap gains, he caps risk. He trims only when valuation becomes extreme, not when he is up a lot. He does not care about tax efficiency in the short term. He cares about compounding in the long term. He would rather pay more taxes on a 10 times return than lock in a 2 times return too early. He documents every buy and sell decision with date, price, thesis, valuation, and expected holding period. He reviews these logs annually, not to celebrate wins, but to learn from mistakes. Why did he sell too early? Why did he hold too long? What assumptions were wrong? He does not blame the market. He blames his process. He refines his checklist. He tightens his criteria. He becomes a better crocodile. Not by being right more often, but by being wrong less catastrophically. Finally, the crocodile knows that most mistakes are made at the edges. Buying too early, selling too late, chasing momentum, fearing drawdowns, so he builds guardrails, maximum position size, minimum margin of safety, mandatory checklist, quarterly reviews. He does not rely on willpower, he relies on systems. Because willpower fails under stress, systems endure. The crocodile does not trust his emotions. He trusts his process, and his process is designed to survive and profit from his own human weaknesses. The crocodile does not fear bear markets, he expects them. He knows they are not bugs, they are features of capitalism. Every 5 to 7 years, markets correct. Every 10 to 15 years, they crash. This is not pessimism, it is realism. He does not try to predict when, he prepares for whenever. He keeps cash dry, he owns resilient businesses, he avoids leverage. He does not panic when others do. He leans in. He knows that bear markets are not threats, they are his best friends. They bring him the prices he needs to build long-term wealth. He does not go to cash before crashes because he knows no one can time them. Instead, he stays invested, but selectively. He does not hold cyclical stocks with weak balance sheets. He does not hold overvalued growth stocks with no earnings. He holds businesses that generate cash in all environments: utilities, healthcare, consumer staples, payment processors. These do not shoot the lights out in bull markets, but they hold up in bear markets, and that is enough. He is not trying to win every quarter, he is trying to survive every decade. He uses bear markets to upgrade his portfolio. When panic hits, he does not hide, he hunts. He sells his weakest holdings, the ones with deteriorating fundamentals or shrinking moats, and uses the proceeds to buy his highest conviction names at fire sale prices. He does not buy the market. He buys specific businesses he has been stalking for years. He does not dollar cost average blindly. He scales in only when valuation reaches his buy zone. He does not catch falling knives, he catches falling diamonds. He does not listen to macro forecasts. He does not care if inflation is 2% or 8%. He does not care if rates are rising or falling. He cares only about how these factors impact the cash flows of his businesses. Can Coca-Cola raise prices faster than inflation? Can Visa grow transactions regardless of GDP? Can Costco retain members in a recession? If yes, he holds. If no, he avoids. He does not bet on macro trends. He bets on micro resilience. He invests in businesses that can navigate any macro environment, not those that depend on a perfect one. He does not chase yield in low-rate environments. He does not buy junk bonds or REITs just for income. He knows that yield without safety is a trap. He prefers businesses that grow dividends organically, not those that pay high yields because they are desperate. He would rather own a stock with a 2% yield growing at 10% per year than a 6% yielder with stagnant cash flow. Total return, not current income, is his goal. He reinvests dividends automatically, not to boost yield, but to compound ownership. He does not panic when the market drops 30%. He expects it. He has seen it before. He knows that markets recover, always, not tomorrow, not next month, but eventually. He does not sell to avoid further losses. He knows that selling locks in losses, holding allows recovery. He does not check his portfolio daily during crashes. He checks it quarterly. He does not read financial news. He reads annual reports. He does not react. He reflects. He asks, has anything changed in my businesses? If no, he does nothing. If yes, he acts calmly, deliberately. He does not compare himself to others during downturns. He does not care if his neighbor is down less or if some fund is beating the market. He cares only if his process is intact. He knows that short-term performance is noise, long-term compounding is signal. He does not chase performance, he chases durability. He does not measure success by relative returns. He measures it by absolute wealth creation. He is not competing with anyone. He is building his own future. He uses volatility to his advantage. When stocks swing wildly, he does not get emotional, he gets strategic. He places limit orders below market to buy on dips. He places limit orders above market to sell on spikes. He does not trade daily, but he uses volatility to improve entry and exit prices. He does not fear gaps, he exploits them. He knows that emotional traders create mispricing, and mispricing creates opportunity. He does not fight volatility, he harvests it. He does not try to make back losses quickly. He knows that is how blow-ups happen. He stays disciplined. He does not increase position sizes to catch up. He does not chase meme stocks or leveraged ETFs. He does not abandon his process because he is behind. He trusts compounding. He knows that a 15% annual return doubles money every 5 years. No heroics needed. He does not need to be a genius. He just needs to not be an idiot. And the biggest idiot move is abandoning discipline. After a drawdown. Finally, the crocodile knows that market cycles are psychological as much as financial. The same patterns repeat: greed, euphoria, denial, fear, capitulation, despair, hope, recovery. He does not fight these emotions in others. He observes them. He does not try to convince people they are wrong. He waits for them to exhaust themselves. He does not argue with bulls at market tops. He quietly trims. He does not mock bears at market bottoms. He quietly accumulates. He does not need to be right in the moment. He needs to be right over time, and he will be, because he plays a different game, a longer game, a crocodile's game. The crocodile's greatest enemy is not the market, it is himself. Human psychology is wired to sabotage long-term investing. The crocodile knows this, so he builds systems to defeat his own instincts. He does not rely on willpower, he relies on rules. He automates buys, he blocks financial news sites, he hides his portfolio performance. He does not check stock prices daily, he reviews fundamentals quarterly. He knows that information overload leads to action bias, and action bias leads to mistakes, so he minimizes inputs and maximizes discipline. He avoids the fear of missing out trap. He does not chase stocks because they are going up. He does not buy IPOs, SPACs, or meme stocks no matter how much everyone else is making. He knows that FOMO is the killer of portfolios. He would rather miss a 100% gain than suffer a 50% loss. He does not need to own every winner, he just needs to avoid every loser. He measures success not by what he caught, but by what he avoided. His portfolio is defined by absence. No crypto, no biotech gambles, no pre-revenue startups, no turnarounds, boring, yes, profitable, consistently. He does not fall for "this time is different." Every bubble has its justification. New era, disruptive tech, paradigm shift. The crocodile has heard them all and ignored them all. He knows that while technology changes, human nature does not. Valuation still matters, cash flow still matters, moats still matter. He does not invest in stories, he invests in numbers. He does not care if a CEO is a visionary. He cares if the unit economics work. He does not bet on adoption curves, he bets on proven cash generation. He is not anti-innovation, he is pro-survival. He avoids overconfidence. He does not think he is smarter than the market. He does not believe his analysis is infallible. He assumes he is wrong 40% of the time and builds margin of safety accordingly. He does not size positions based on certainty. He sizes them based on uncertainty. The more uncertain the future, the smaller the position. He does not bet the farm on sure things, because sure things do not exist. He is humble in victory, disciplined in defeat. He does not keep trophies of his wins, he keeps logs of his losses. He learns more from failure than success. He does not confuse brains with results. Many smart people lose money in markets because markets do not reward intelligence, they reward patience, discipline, and emotional control. The crocodile does not need an MBA or a CFA. He needs a checklist and the guts to follow it. He does not read complex option strategies. He reads simple annual reports. He does not try to outsmart algorithms. He tries to outlast them. He knows that the tortoise did not win the race by being fast. He won by not stopping. The crocodile does not sprint, he endures. He avoids recency bias in all forms. Just because a stock went up does not mean it is good. Just because a strategy worked last year does not mean it will work next year. Just because inflation was low does not mean it will stay low. The crocodile thinks in decades, not quarters. He studies 50-year market history, not 50-day charts. He knows that what is normal today was unthinkable 10 years ago and will be obsolete 10 years from now. He does not extrapolate trends, he prepares for regime shifts. He does not listen to financial media. He knows that CNBC, Bloomberg, and Twitter are entertainment, not education. They reward drama, not truth. They amplify noise, not signal. He does not watch market open or close. He watches earnings calls and industry conferences. He does not read hot stock tips. He reads 10K footnotes. He does not follow gurus. He follows cash flows. He knows that the best investors are silent, not sensational. He does not need daily updates. He needs annual insights. He avoids complexity. He does not invest in businesses he does not understand, no matter how promising they seem. He does not buy derivatives, structured products, or leveraged ETFs. He does not use options for income or hedging. He keeps it simple, buy shares in cash-generating businesses at good prices, hold, reinvest, repeat. He knows that complexity hides risk, simplicity reveals it. He does not need fancy tools. He needs clear thinking. He does not optimize for tax efficiency or alpha generation. He optimizes for sleep quality and adherence. He does not chase yield. High dividend yields are often value traps. Businesses in decline, using dividends to attract desperate investors. The crocodile prefers low yields with high growth, because total return matters more than current income. He does not buy REITs, BDCs, or MLPs just for yield. He buys them only if they meet his business criteria. He knows that dividends are optional, cash flow is mandatory. He would rather own a stock that reinvests profits at 20% ROIC than one that pays a 6% dividend with 0% growth. Finally, the crocodile avoids the biggest trap of all, abandoning his process after a big win. He does not get greedy after a big loss. He does not get scared. He sticks to his checklist. He sticks to his valuation models. He sticks to his position sizing rules. He does not adapt to the market. He lets the market adapt to him. He knows that discipline is not a constraint. It is his superpower. He does not need to be right all the time. He just needs to be disciplined all the time. And that is how crocodiles outlast bears, bulls, and every other predator in the financial jungle. Becoming a crocodile investor is not about brilliance. It is about behavior. It is not about finding the next 100 times stock. It is about avoiding the next 90% drawdown. It is not about complex algorithms. It is about simple rules, followed relentlessly. The crocodile does not need to be the smartest in the room. He just needs to be the most disciplined. He does not chase returns. He lets returns come to him. He does not force outcomes. He creates conditions where favorable outcomes are inevitable over time, with patience, without drama. He starts small but thinks big. He does not need millions to begin. He starts with $1,000, then $10,000, then $100,000. He invests consistently, not when he feels like it, but automatically every month. He treats investing like a utility bill, non-negotiable, recurring, boring. He does not wait for the right time. He knows the right time is always now. He does not need perfect conditions. He needs consistent action. He saves first, spends second. He lives below his means, not to be frugal, but to be free, free to wait, free to pounce, free to ignore the noise. He documents everything, every buy, every sell, every thesis, every mistake. He does not rely on memory. He relies on data. He reviews his journal annually, not to celebrate, but to improve. He does not hide his losses. He studies them. He does not take credit for luck. He attributes wins to process. He knows that ego is the enemy of learning, so he stays humble, he stays curious, he stays skeptical, especially of his own assumptions. He does not defend his positions. He stress tests them. He does not seek confirmation. He seeks disconfirmation. He is not trying to be right. He is trying to be less wrong. He ignores benchmarks. He does not care if he beats the S&P 500 this year or next. He cares if he is compounding at 10 to 15% annually over 20 years. He knows that short-term underperformance is the price of long-term outperformance. He does not chase index returns. He chases absolute wealth. He does not measure success in percentages. He measures it in purchasing power, in freedom, in options. He does not invest to impress others. He invests to liberate himself. His portfolio is not a report card. It is a passport. He does not need external validation. He does not post his gains online. He does not argue with strangers about stock picks. He does not seek praise or avoid criticism. He invests in silence. He tracks progress in spreadsheets. He celebrates milestones privately, not with champagne, but with increased savings rate. He knows that the richest people are not the ones with the flashiest portfolios. They are the ones who never had to sell at the bottom. He does not want to be famous. He wants to be financially untouchable. He prepares for black swans not by predicting them but by surviving them. He keeps cash. He avoids debt. He owns resilient businesses. He does not bet on stability. He bets on adaptability. He knows that the next crisis will be different from the last, but his response will be the same: do nothing unless fundamentals change. He does not panic. He does not predict. He does not hedge. He waits. He watches. He acts only when the math is undeniable. He does not need to be first. He just needs to be last, the last one standing, the last one compounding. He does not retire from investing. He retires because of investing. He does not stop when he hits a number. He stops when he has enough to live without fear, enough to say no, enough to pursue passions, not paychecks. He does not measure retirement by age. He measures it by passive income. When his portfolio generates more than he spends, he is free, not because he stopped working, but because he no longer has to. The crocodile does not chase early retirement. He chases permanent optionality, the freedom to work or not on his terms forever. He passes on principles, not picks. He does not teach his children stock tickers. He teaches them valuation, patience, margin of safety. He does not leave them a portfolio. He leaves them a process. He knows that money can be lost in a generation, but wisdom lasts forever. He does not brag about returns. He brags about discipline. He does not measure his legacy in net worth. He measures it in financial literacy passed down. He does not want his heirs to be rich. He wants them to be resilient. He does not fear death. He fears irrelevance. He knows his portfolio will outlive him, but only if it is built on timeless principles. He does not invest in fads. He invests in foundations. He does not chase performance. He chases permanence. He wants his capital to compound for decades after he is gone. Not because he is vain, but because he is responsible. He does not see investing as a game. He sees it as stewardship of his family's future, of his values, of his freedom. He does not play to win. He plays to endure. And now, if this mindset resonates with you, if you are tired of chasing trends, reacting to noise, and sabotaging your own progress, then it is time to become the crocodile. Start today, pick one stock, do the work, buy it at a discount, hold it for 10 years, reinvest the dividends, ignore the headlines, review annually, repeat. You do not need to be brilliant, you do not need to be lucky, you just need to be still, to be patient, to be disciplined. That is how ordinary people build extraordinary wealth, not with noise, with silence, not with action, with inaction, not with speed, with stillness. Become the crocodile. The market will feed you, if you let it. If this approach changed how you think about investing, smash that like button. It helps more people find this mindset. Subscribe and hit the bell, because we break down real, timeless strategies every week. No fluff, no hype, just crocodile logic. Drop a comment below. What is the #1 behavior you are quitting to become a better investor? Let us build a tribe of patient predators together. See you in the next video.